Gold and silver investors, ignore this signal at your own risk. Somewhere, right now, a chart is quietly forming, one that has appeared only a handful of times in the last 100 years. And each time it appeared, fortunes were made and fortunes were lost. Most investors are watching gold. Most investors are watching silver. But almost no one is watching the one signal that has always moved first. Before the metals, before the headlines, before the panic buying begins. By the end of this video, you will understand exactly what that signal is, and why ignoring it, even for a few more weeks, could mean missing the most important window of this decade. So stay with us, because what comes next changes everything. Welcome back to Precious Metals Intelligence, a channel built for serious investors who prefer clarity over noise and evidence over emotion. If you are new here, thank you for trusting us with your time today. We know your time is valuable, and we do not take that lightly. If this kind of grounded, no-hype economic analysis speaks to you, we would be honored if you considered subscribing, not for the sake of a number on a screen, but because it helps this kind of careful, independent research reach the people who genuinely need it. Many of you have been investors for decades, and you already know that the loudest voices in this market are rarely the most reliable ones. We simply try to be one of the quiet, steady ones. For most people who follow gold and silver, the story always begins in the same place. They watch the price of gold. They watch the price of silver. They wait for the number to move, and when it does not move fast enough, they lose interest and look away. This is how most investors have always behaved, and it is exactly why most investors miss what happens next. To understand why this moment is different, it helps to step back and look at the bigger picture first. For more than a decade, the global economy has been shaped by forces that most people rarely stop to think about. Central banks have printed enormous amounts of money. Governments have borrowed at levels that would have seemed impossible a generation ago. Interest rates have been pushed up and down again and again in an effort to control inflation without breaking the economy completely. Each of these decisions was presented to the public as necessary, even routine, but underneath the surface, they were slowly changing the value of paper money itself. Gold and silver have always responded to this kind of pressure. They are old forms of money, older than any currency used today. When people lose confidence in paper money, history shows that they eventually return to something they cannot print out of thin air. This is not a new idea. It is one of the oldest patterns in economic history, and yet somehow each generation forgets it, right up until the moment they are forced to remember. Right now, most investors believe they already understand this story. They believe that if gold and silver are going to make a major move, they will see it coming through the price charts of gold and silver themselves. This is where the mistake begins. The truth is that gold and silver prices are often the last piece of the puzzle to move, not the first. Long before bullion prices break out, the companies responsible for finding and producing that gold and silver often begin to shift first. Investment flows into exploration. Capital starts moving into smaller mining companies. Risk appetite in this corner of the market begins to change quietly, long before it ever appears in the price of the metal itself. This is the part of the story that almost no one is watching. It is not exciting. It does not make headlines. It does not trend on social media. For years, this part of the market can sit still, moving sideways, doing nothing that would catch the attention of a casual observer. Many investors look at this kind of long, quiet period and conclude that nothing important is happening. They call it dead money. They move their attention elsewhere, toward faster-moving assets that offer quicker excitement and quicker rewards. But history does not agree with them. Time and again over the past century, the same pattern has repeated itself. A long, quiet period, a slow, grinding sideways movement that tests the patience of even experienced investors. And then, without much warning, a sudden and powerful shift that catches almost everyone off guard. The people who profited the most from these shifts were rarely the ones who reacted after the move had already begun. They were the ones who paid attention during the quiet years, when almost no one else was watching. This is not a story about luck. It is a story about timing, patience, and understanding where to look before everyone else is looking in the same place. Today, that same quiet pattern appears to be forming again, not in the price of gold, not in the price of silver, but in the part of the market that has historically moved first, long before the metals themselves ever catch up. Most investors do not know this pattern exists. Fewer still know how to read it. And even among those who do understand it, many will choose to ignore it, simply because it does not feel urgent yet. It does not feel dramatic yet. It looks on the surface like nothing at all. That is exactly how it has always looked right before everything changed. In the next part of this story, the specific signal itself will be explained in plain terms. What it is, why it has been so reliable in the past, and why so few people are paying attention to it, even now, while there is still time to prepare. There is an old saying among people who have spent decades studying markets. The crowd rarely watches the right chart. They watch the chart that feels the most urgent. They watch the number that moves the fastest. But the chart that actually matters is often sitting quietly off to the side, ignored by almost everyone. This is the situation unfolding right now. To understand it, one has to ask a simple question. Where does gold and silver actually come from? Not from a bank vault, not from a trading screen. It comes out of the ground through the work of mining companies, many of them small, many of them unknown to the average investor. These companies search for new deposits. They raise money to dig, to test, to prove that the gold or silver they believe is underground is actually there. This process happens long before a single ounce of metal ever reaches a market. There is a specific index that tracks many of these companies together. It is not widely followed by the general public. Most people have never heard of it. But those who study precious metals closely understand that this index behaves differently from gold and silver themselves. It tends to move first. It tends to react to shifts in investor confidence, capital flow, and risk appetite before those same shifts appear in the price of bullion. Think of it this way. Gold and silver prices reflect what people are willing to pay for the metal today. But this index reflects something different. It reflects what investors believe will happen in the future. It reflects whether people are willing to take on risk, fund new exploration, and bet on companies that have not yet proven their success. When confidence is low, this index sits still, sometimes for years at a time. When confidence begins to return, this index often moves before anyone notices a change in the price of gold or silver. This is not a new pattern. It has appeared before, at important turning points in market history. Each time it looked the same. A long, quiet period of little movement, low attention from the public, almost no excitement. And then, without much warning, a shift that caught most people by surprise, followed by strong gains in the mining companies that were positioned early. The people who study this index closely are not looking for excitement. They are looking for structure. They are looking at how prices have moved over many years, searching for patterns that tend to repeat themselves across long periods of time. One of the most important patterns is something researchers call a base. A base is simply a long period where prices move sideways, testing the same upper and lower limits again and again without breaking through in either direction. A short base does not mean very much. It can happen for simple, temporary reasons. But a long base, one that stretches across many years, tends to mean something very different. It suggests that a large amount of pressure is building quietly, without release. And history shows that the longer this kind of pressure builds, the more significant the eventual move tends to be once it finally happens. This is the situation that appears to be forming again today. Not a short pause, not a temporary dip, a long multi-year period of quiet sideways movement, the kind that has, in the past, come before some of the most important shifts in the entire precious metal sector. Most investors are not watching this. They are watching gold. They are watching silver. They are checking prices daily, sometimes hourly, waiting for something dramatic to happen in the numbers they already know how to follow. Meanwhile, the indicator that has often moved first, the one with a long history of leading rather than following, continues to build quietly in the background. This is not a guarantee of what will happen next. No serious analyst would ever claim certainty about the future. But it is a pattern that has appeared before, a pattern that history suggests should not be ignored. There is a strange trick that time plays on the human mind. And when something happens quickly, people pay attention. When something happens slowly, over years instead of days, people stop noticing it at all. This is one of the oldest weaknesses in investing, and it has cost people more money throughout history than almost any single bad decision ever could. This weakness becomes especially dangerous during long periods of sideways movement, the kind now forming in the part of the market tied closely to gold and silver mining. To understand why, it helps to think about how most people experience time when nothing seems to be happening. A week of no movement feels uneventful. A month of no movement feels boring. But a year of no movement, followed by another year, and then another, begins to feel like proof that nothing will ever happen at all. This is not a logical conclusion. It is an emotional one. And markets are shaped far more by emotion than most people like to admit. History offers a clear lesson here, repeated many times across different decades and different sectors. Long periods of quiet, sideways movement, sometimes stretching across 10 years or more, have often come before some of the largest and most powerful moves in commodity markets. This is not a coincidence. It reflects something structural about how capital behaves during periods of low interest and low confidence. When investors lose interest in a sector, money stops flowing into it. Fewer new projects get funded. Fewer new companies get built. The people running these companies often have to work harder just to survive, becoming leaner, more efficient, and more disciplined out of necessity rather than choice. This quiet period, uncomfortable as it feels, often does something important beneath the surface. It clears out weak companies, strengthens the ones that remain, and sets the stage for a much more powerful response once conditions finally begin to shift. The danger is that almost no one recognizes this process while it is happening. It does not look like opportunity. It looks like stagnation. It looks like a part of the market that has simply been forgotten. And in many cases, that is exactly what it becomes, at least for a while. This is where an important trap begins to form, one that has repeated itself again and again throughout financial history. Investors watch a sector move sideways for 1 year, then 2, then several more. Slowly, their patience wears down. They begin telling themselves the same story, one that feels reasonable at the time. They say the sector is dead. They say the old rules no longer apply. They say their capital would be better used somewhere else, somewhere faster, somewhere more exciting. And so they leave. They leave not because the underlying pattern has broken down, but because they have simply run out of patience waiting for it to resolve. This is one of the most consistent behaviors observed across long market cycles. The exit tends to happen not at the bottom and not during the quiet years, but shortly before the eventual move begins, right when the base is finally nearing its end. This is why long periods of consolidation are often described, by those who study them closely, as the most dangerous phase for investor psychology, even though they are usually the least dangerous phase in terms of actual price risk. The real danger is not that prices will fall sharply from here. The real danger is that people give up their position right before the pattern they were waiting for finally plays out. The current setup in the index tied to gold and silver mining companies reflects exactly this kind of extended multi-year base. It has tested the same boundaries several times without breaking through, each attempt slightly different from the last, each one building on the pressure left behind by the one before it. Whether this particular base finally resolves in the way similar patterns have resolved in the past cannot be stated with certainty. No one can promise the future, but history offers a clear warning about what tends to happen to investors who lose patience during long, quiet periods like this one, and what tends to happen to those who choose to remain, even when the story feels uneventful. In the next part of this story, the discussion turns to what may finally break this long period of quiet, and why the cost of waiting for confirmation could turn out to be far higher than most investors currently expect. Every long period of quiet eventually comes to an end. The harder question is not whether that end will come, but what finally causes it, and whether investors will recognize it in time to act, rather than simply reading about it afterward. Throughout history, the forces that finally break a long, sideways pattern in commodities and mining have rarely announced themselves in advance. They do not arrive with a warning. They tend to arrive quietly, often disguised as ordinary business decisions, long before the broader public understands their significance. One of the most reliable forces of this kind involves the largest companies in an industry deciding, almost all at once, that they can no longer wait. In the case of gold and silver mining, this typically happens when large producers realize that their existing reserves are shrinking faster than they can replace them. For years, these companies can continue operating on what they already have in the ground. But eventually, that supply runs low, and a difficult choice has to be made. They can either spend heavily to explore for new deposits themselves, a slow and uncertain process, or they can simply buy the smaller companies that have already done that work. History shows that large companies almost always choose the second option, once the pressure becomes serious enough. This is not a new behavior. It has repeated itself across many industries and many decades. When profit margins are healthy and cash reserves are strong, acquiring proven assets becomes far more attractive than searching for new ones from scratch. This is precisely the environment that appears to be building today, as many major producers report some of the strongest profit margins they have seen in years, even while the smaller companies around them remain quiet, undervalued, and largely ignored. When this kind of buying activity begins, it rarely stays contained to a single company. Once one major acquisition takes place, competitors often feel pressured to respond, fearing they will be left behind without enough future supply of their own. This can create a chain reaction, where one purchase leads to another, and then another, drawing renewed attention to an entire sector that had been forgotten for years. This is the moment long-term patience is finally rewarded, but it is also the moment where waiting too long carries the greatest cost. By the time this kind of activity becomes widely reported, by the time it appears in financial headlines and mainstream coverage, much of the movement has often already occurred. Prices that once sat quietly for years can shift rapidly once broader attention returns, leaving very little time for those who were waiting for confirmation before acting. This is not a comfortable truth, but it is a consistent one, observed again and again throughout market history. The investors who benefited the most from previous cycles like this one were rarely those who waited for certainty. They were the ones willing to sit through the quiet, uneventful years, understanding that the discomfort of doing nothing was, in fact, part of the process, not a sign that the process had failed. This does not mean the outcome is guaranteed. No pattern in markets carries a promise. But it does mean that the cost of inaction, of continuing to wait for undeniable proof before paying attention, has historically been far higher than the discomfort of acting, while conditions still look uncertain. Right now, the signal tied to gold and silver mining sits at exactly this kind of turning point. Quiet, unremarkable, easy to dismiss, and according to history, potentially very close to the moment it finally demands attention. What happens next cannot be known with certainty. But how investors choose to respond during this quiet window before the story becomes obvious to everyone else may end up mattering more than almost any other decision they make in this market for years to come.